Hello, folks. Brandon Chapman with you today. It's another Monday video from TheoTRADE. It is, February 5th, man. We're into February already. And, the groundhog doesn't see a shadow. Early spring. I'm looking for it. I'm prepared for warmer weather, man. We're in Utah. It hasn't been a rough winter by any means. But, we had a retreat last November in Florida. And you suddenly realize there's places in the world that are 80 degrees with 80-degree water, even in November, and you start to yearn for those kind of conditions, at least not 80-degree weather, but hey, at least 80-degree temperatures, or hey, just give me the 60s, I'll be just fine. Well, let's get rolling here. So the S&P 500 did finish down about 0.33%, SPY down 0.36%, off the lows of the session. And if you look at the leadership today, it really tells a story that healthcare and technology were the only two green sectors on the day. And so big positive revisions from big tech ultimately runs against the bond wall. What does that mean? It basically suggests that treasury yields are not participating, or treasuries are not participating. What that means is we're seeing a sell-off both Friday and today. That interview with Powell over the weekend suggesting there's no March rate cut. I mean, what a Grinch. I mean, why is it going to give us lower yields by virtue of a lower Fed funds rate? And I'm going to refresh this page so we can see it. I mean, what a Grinch. Why is he going to try to steal Christmas from us next year? The reality is the fact that we're really looking at cutting it all right now is interesting in the face of what appears to be at least surface level data. It's not too bad. And inflation, certainly not in check. And so by all the measures what the Fed ultimately looks at to consider interest rate policy, how in the world are we only anticipating an 83% probability of standing pat in the next meeting and 16.5% chance of a quarter point cut? I mean, didn't they just tell us they're not going to cut rates in the next meeting? Again, some may be trying to walk that back a little bit, but the point is we're kind of in a state of confusion, right? We have pretty incredible earnings from companies like Meta, companies like Amazon, and for the most part, they had big moves last Friday. Well, do we believe the narrative here? Well, if we look at the S&P 500, we'll take SPY as an example, right? We're basically just off Friday's all-time high. But if we look at RSP, we're looking at an equal weighted index. We're not even above the high from December 14th. I mean, it really puts into perspective that when you start to account for other companies, other than those monsters of tech, as Don names them, you start to realize that on an equal weighted basis, we've not seen any gains since when? Since December 14th. That happened to be a day during my daily session where we took some volatility measures and we decided, hey, this was an adequate signal to start to hedge, to reduce your exposure. And the fact of the matter is, when we look at the bond space and we're seeing treasury bonds sell off and yields move higher, this is a wall of worry that's developing here. If the Fed isn't going to cut rates, and if inflation is still cooking, and we look at some belated measures like GDP and employment as some sort of indication for the real economy, this should mean higher yields going forward from now. And that does not bode well for the monsters of tech, companies like Meta. Meta's interesting, right? Meta, if we look at, I'm going to bring up Yahoo here. We'll kind of look at some of the information on Meta. Meta had some massive positive revisions on Friday, or after Friday today, right? You look at its valuation, 1.2 trillion, right? Its PEG ratio, we'll look at a different view of that, but its PE, a forward PE ratio, 27 times. That's high. EV to EBITDA, 20. I mean, you figure probably 15 on the forward PE and 10 on the EV to EBITDA. Now you're in that territory where we're talking about a value stock. This company's trading at multiples of that. Price to book, 9 times sales. What kind of growth are we expecting here? Let's go to the analysis page and see how things have shifted. You can see last year's earnings, this year's projected earnings, next year's earnings. You can scroll down here and see the percentage change, right? Quarter over quarter, year over year, both current year and next year, and 5 years growth. Okay, great. This company's expected to grow its earnings 26% a year for the next 5 years. What is its PE ratio right now? Come back to statistics here. Its PE ratio is 31. What does that mean? It's a little bit over 1 on the peg, which is this is kind of indicating right there. So the point being, is this a value stock? It's bordering on it if we just look at the current trajectory of value. But when you start to consider next year's earnings and EV to EBITDA, you're saying, wow, this is kind of expensive. When we look at the analysis page, we look at, for example, how have earnings revisions changed, or how have earnings changed since the earnings announcement? Last week, 1757. Current is 1921. That's a significant jump of about $1.70 or 10% in 2024 earnings. Next quarter, or the current quarter rather, about a 70% bump, 65-cent bump off of 350. We're talking about 17, 18%. Next year, 20.17, 22.33, a difference of about 2 or a 10% positive change. So earnings expectations for current year and next year rose 10%. Okay, great. How much did the stock go up though? So let's look at this, right? We look at where we closed the day before and where we finished at the high, 23%. We finished at around a 20% gain on Friday. So while earnings revisions for this year and next were 10%, we saw a 20% adjustment in the price, basically saying, look, all of you future earnings that are a result of, these positive revisions, we're dragging them back to the present and appreciating the stock by over 20%. Okay, this is an interesting phenomenon, right? Kashkari today, one of the Fed heads, basically, again, he's a dove, saying they can take their time on cutting rates. Well, look, folks, again, we're up against the bond wall right now. If bonds continue to sell off, how is it that Meta and stocks like Amazon can continue to rise? Let's look at Amazon here, right? Beat earnings, beat revenues, raised guidance. Let's come back in here. We're going to look at Amazon. We're going to look at its multiples. We're going to look at some of the revisions. Statistics page. Well, look at this, right? 59 times trailing earnings. It's huge. 47 times forward P, taking next year's earnings on a price basis, 47 times. Again, 15 or less would be a value territory. 10 on the EBITDA would be a value territory. It's double that. Really interesting, right? And this is a company that's only generating 5% profit margins, 7.5% operating margins. Normally you have gross margins to be over 40%. This should be over 7.5% for a growth stock. But guess what? Look what's going on. We go to the analysis page here. We scroll down to the bottom. You see a 16% earnings growth rate on 11% projected growth in revenue this year and next year. With such a low margin company, how do we experience this degree of earnings growth when in the prior 5 years, we're only talking 6%? Okay, we are seeing organic growth at 11%, but remember, our margins are only 5%. They've got to cut costs, don't they? So we're seeing these big numbers going into next year. We're seeing these revisions, right? Current year, 363 a week ago. Today, 398. It's a 10% increase, right? 486 to 525. And you don't see it embedded in here because we're going 7 days ago, but there was about a 10% revision at the beginning of the year. You can't see in the kind of the minutiae here. We have seen some significant positive revisions. The bar is getting raised for these companies. Can they continue to jump over it? You look over here, buy and strong buy. Buy and strong buy right here. You're still seeing a very much upward bias in terms of buy recommendations. But here's the problem though, right? Again, we had a 7-8% move on Friday. How much of the future return here has already been dragged back to the present? How much of the run off of the lows? We're talking about multiples that are very, very high for extremely large cap companies. It's kind of crazy when you think about it that way, right? Let's go to statistics here. This is a $1.78 trillion company. How does a company like this grow its revenues 11% and its earnings at 16%, virtually in perpetuity? Okay, you compare it against Walmart that has a 3-for-1 split coming up. I mean, look, Walmart's trading at maybe a quarter of that market cap. Its revenues aren't quite where, if we look at financials here, aren't quite where I don't believe where Amazon's is. In fact, let's just quickly look at it with WMT. Maybe it's higher. I think it's 600 billion. Yes, we have more revenue in Walmart. You look at net income down here, right? $16.2 billion. Amazon. Revenue's higher. Sorry, earnings are higher in this one. Net income's higher, about 30 billion. Their margins are not quite double. Let's go to Walmart here, right? Go back to statistics. Their margins are what? Net profit margin is about 2.5%, about double. What about the valuations? EV to EBITDA? Okay, it's about double. Price to book, about double. Trailing PE, right? Forward PE, not quite double. We might suggest right now that Amazon, given its current earnings, is maybe a better value than Walmart. But Walmart's generating more in revenues. And again, we're seeing right now that margins have improved for Amazon, and Amazon's kind of sitting at a high right now. Well, if we're to compare Meta and Amazon, at least Amazon's a better value. And if we look at Amazon, Amazon's probably, if the market's going to go higher, Amazon should probably perform. As we look at the volatility in Amazon right now, let's go to March expiration. The volatility starts to level off out here about 180 to 190. Could you buy a 180 and sell a 190 39 days out? It's going to cost you, what, about $1.55 on a $10 spread if Amazon goes to 190, which is right here. Break even is about 181, 182. Point being is if Amazon keeps going, that's one way to tackle it. Buy a 180, sell a 190. But again, we have this confusing environment where the Fed is holding back on us in terms of cutting rates, and the 10-year Treasury yield selling off here. Again, the 10-year's up about 1.31. The 5-year is up about 1.28. And the 30-year TYX is up 1.18. What we're seeing today is that the 5, 10, and 30 are getting closer together at a higher yield. If we look at IRX, this is a 3-month T-bill. This reflects kind of the Fed funds rate or expectations. This is now back over 5.25%. Just move that, or close to 5.25%. Just move that over a decimal point. So we'll see who's right. But the fact of the matter is, these monsters of tech are reaching extremes in terms of valuation based on some really lofty expectations and lofty improvements and lofty adjustments to forward earnings. The fact of the matter is, we looked at the press release in my session on Friday, and the fact of the matter is, at least in the press release, the company only gave guidance on revenue for the upcoming year. I believe it was 34 to 37. This is adjusted, and sales growth is expected to be 25%. But here's the deal, though, right? They talked about higher costs. How in the world does this company grow its earnings at 26% a year with a higher cost structure and revenues that are growing at around 12 to 18%? Again, I think we're hitting this point where optimism might be a bit excessive, but it makes sense. These are the only companies that have worked so far in 2024, and you see them going to the trough again in NVIDIA, trading at exorbitant 80 plus times valuations on its PE. But somehow the analysts are expecting 100% earnings growth a year for the next 5 years. Crazy to think about that, right? Have we reached this peak in optimism? So again, this is a point right now where you got to be a little bit nervous about where these are going. Yes, we're relying on a handful of companies to provide all of the gains this year in the market. And all you got to do is look at RSP, an equal weighted S&P 500 index, and it has had no gains since when? Since December 14th. The dollar itself today, dollar ended up picking up speed, right? Against what? Predominantly against the euro. So if we look at the euro / USD, you'll see we're breaking to the downside, dollar strengthening against the euro. If we draw some fib retracements, we get a sense of where key levels are. Well, guess what? Today's low is a key level. We take out 107. We're expecting the dollar to appreciate against the euro back to 104.50. And what does this tell us? This should place bearish pressure on gold. GLD was down 0.55% today on that stronger dollar. And again, the dollar index does not exactly directly relate to gold. This is the real value of the dollar. The other is the relative value of the dollar. There is a chance that gold kind of holds up here as the dollar beats out the euro and other foreign currencies, but doesn't beat gold. We'll have to watch this. If gold starts to appreciate with the dollar index, this may prove to be a bit troubling for the S&P 500 to finish down 0.36% today, backed by healthcare. And again, technology is right there front and central. Again, NVIDIA pushing new highs ahead of its earnings here in a few weeks. If we look at interest rate sectors, interest rate sensitive sectors, utilities, for example, utilities had a hard day, down 2% today, finished near the low of the session, back against the wall from the January lows. Real estate finished just off the lows of the session, but below the previous low from last Friday and below a key level of support back there around 38. Again, real estate continuing to tumble here. In fact, today we look at a February to March rolling selling the 40 in the money for February, rolling it to the 39 in the money for March. And again, just keeping that sucker going, taking maybe 70, 80 cents off the table, maybe covering the basis, but provided, again, this has more downside. We look at the strength of the initial sell-off here. Again, 36.50 seems pretty reasonable. We start to take out this area, we may see a full retracement back to October, November lows. And again, very interest rate sensitive. 10-year treasury yields keep going higher. It should continue to place bearish pressure on real estate and, of course, utilities as well. As treasuries are selling off, of course, this is placing pressure on the corporate bond space, in particular, high yield credit. Down nearly 0.5% today, near a key level of support. We start to break this kind of 76.50 area. We may have a chance to roll or run down towards what? Towards the 75.5 and then 74. You break 74, really it's going back to 72.50. So while we're oversold in the near term, again, expect this to have more downside as the pressure builds to the Fed for the Fed to cut rates. And if they don't, and yields continue to back up in terms of the treasury yields, it should have a doubly negative effect on HYG as risk spreads start to widen and the risk-free rate rises. As we look at the 5 years, probably a better proxy for HYG, but 5 years selling off more, right? HYG has a relatively low duration, which is kind of like the delta for interest rates. So we look at these sectors, right? An industry, KRE, regional banks. We had the New York Community Bank who absorbed the Signature Bank have issues. We had the Japanese bank start to choke on the commercial real estate portfolio. We bounced back a little on Friday. We had an inside day today. Again, we're looking at this low from Friday at around 46.50. We start to break here. We may roll all the way back. You look at the strength of this rally here, or the sell-off. We measure this range, 161, 138. We look at 44 as that next level, and then break 44, we're looking at 38 in KRE. So it seems like the interest rate sensitive side, the regional bank side of this space certainly is one part of the market that should continue to see weakness if treasury yields continue to rise. That's the 5-year, the 10-year, and the 30-year as the yield curve continues to flatten, or the yield difference between the 5, 10, and 30 begins to narrow. And obviously we may see that, again, if the Fed's not going to cut rates, this may back up the truck here. So there is a very definitive wall, right? And that is, again, the 10-year treasury yield. If the Fed is not going to cut rates, we're up here 5.25 to 5.5%. How much further can the 10-year, this benchmark interest rate, how much further can it be down? In this case, we're talking about 1.5% at these lows. Probably 1.25% is probably more typical. Well, if we're 5.25 to 5.5%, are we talking 4.25 to 4.5%? We may see further selling, and this could cause things to unwind this week as the bond wall of worry continues to pressure. And this wall of worry is about the Fed not cutting rates, not providing accommodation, and doubling down with the fact that inflation's not under control, and the idea that we have a lot of interest rate sensitive parts of the markets that are not participating in the rally, We're resting on very, very narrow shoulders, granted broad shoulders, but very narrow in terms of the scope of the market. They do represent probably about 25% of the S&P's market cap, but the other 75 is not performing the way you might expect. Let's wrap things up here with a couple of unusual option activity stuff. We looked at XLRE. Again, with geopolitical conflict, you look at /CL, we look at oil, back down at support again. Okay, so back down to support. We go to the product depth curve here, /CL. We go to futures, and what you'll see is that we have flipped here just a little bit, right? We were in backwardation. We've flattened out, which is bearish. And now we're back at support again. Where do we go from here? One that we looked at previously at the floor of support down here was Oxy. Oxy has earnings coming up. We have a similar kind of long-legged spinning top as what we saw back on the 18th of January. And we're seeing more option activity come in. Now, granted, the earnings, this can create some problems, right? We don't exactly know what that's going to be, but you're seeing a 9 Feb at the 60 strike, some expectation that we might see a bullish result. And again, the earnings are coming up on the 14th, Valentine's Day, after the market close. So we're expecting to see a little bit of a bounce this week, maybe towards resistance of 59. And again, upside call spreads can be had for this week. You might really get out here 39 days. Yeah, it's kind of flattish, but you could buy a 57.5, sell a 62.50. There's still something to sell in there. And just look for this kind of run back to 62 again, or even closing it at 59 if you're so inclined. Another one as well, we're looking at VFC, this on the bearish side. VF has earnings coming up tomorrow after the market close. So again, I mean, we're seeing some kind of front-running activity for this week. On the bearish side, in this case, buying the 16 put. Again, does somebody know something? Probably not, but the idea is that they're expecting a bearish result here in VFC. And again, it's costing 68 cents. But the great thing about this, the rising vol structure, you could buy a 17 and sell a 16. Buy a 17, sell a 15.5. Buy a 16.5, sell a 15.5 or 15 or 14.5. There's something to be sold out there. You'll see there's about a $2 expected move. That's over 10% expected move on its earnings. So someone's taking the bearish side of this expected move. And again, doesn't hurt to probably consider it as a possibility. Looking back, their last earnings, they had some troubles, and the earnings before that, a little bit of downside. So again, 16, 14, you probably need to break even to close to 15 here. Again, a $2 expected move could easily see that go in the money if we see the downside result. Well, folks, we'll wrap it up there. Let's catch you back next week on the video. Have a great one. Thank you.